when it comes to financing an option, you've got a couple of things that you can do. So there's really two different routes that you can take with this. So the first one is if you were to just get a regular option agreement on a plot of land and go and get planning permission. Let's say that plot of land, you've agreed to buy it for £100,000. Let's say you go and get planning permission, and just to keep the numbers really round, you then, once with planning, that land is worth 200,000. Your options, if you like, for that option is you could either bridge it, and as we've kind of discussed before, there are bridging lenders that will lend against the market value. So what you could do is you could bridge against the 200,000 as opposed to the 100,000, therefore raising hopefully 100% of the purchase price that you've agreed within that option, and then just proceeding with ownership into then either selling it on or going to development finance. The second option you've got is you could just move straight into development finance, and because you've increased the value from £100,000 to £200,000, the development finance lenders will look at that £100,000 of uplift and they will see that as your equity contribution to that deal. So they will look at that and say, okay, you've generated that equity of £100,000. We will see that as you've got some money in this deal. So they're kind of the two options that you can take pretty quickly with just a standard option agreement. If you went down the lease option route, you've got a couple of options as well, which is one, you could, if you agreed to buy a house for 150 and then you ran it as an HMO, for example, and you were netting, say, £1,000 a month and you ran it for 60 months, let's say you were really, really savvy and kept all of that 60 grand and put it to one side. Let's say nothing went wrong with the property whatsoever. Come the end of that, you've agreed to buy it for 150, you do your 75% buy-to-let mortgage on it or HMO mortgage on it, and you've got £60,000 in the bank that you can then go and put towards your deposit. In fact, it would cover your deposit. So in that sense, you've actually self-generated your deposit from the property that you're looking to buy. The other option you've got is if it was agreed at 150, let's say you run it for 5 years. During that 5 years, obviously the value is going to have gone up. You may add some value through refurb or just general tidying up. And let's say come the end of that, again, let's say it's worth £200,000. So there's only a small increase really over those 5 years. Come the end of the 5 years, you then either bridge against the 200,000, or potentially you could even, because you've run it for 5 years, even look at just going straight on to a buy-to-let or HMO mortgage at that point and seeing whether you can kind of convince the lender, well, look, we've run it for 5 years, we've added the value, etc., etc. Proof of receipts maybe of works that you've done may assist in that as well. But normally what people would do at that point is they'd probably go onto a bridging loan, 75% of the 200 grand, which should cover the 150 less interest and fees. And then you just put in the bit that's missing from there. So an option really does, either an option or a lease option, really does give you the flexibility to have all these different financing options come the end of it. And the other option you've got come the end of all of this is actually if it doesn't work, you just walk away and you don't finance it at all. But that's not the plan. Hopefully you would finance it and keep it. But they are the options you've got when financing options.